this issue of timing is really important. And the only thing that matters in the system that we've created is the short term, right? It's the period, we'll call it 18 months of active duty, right? Where you're not fundraising for the next election and you're not, paying back the favors from the last election, where you actually have some work to do. And you're going to do everything you can as government officials to make sure that people feel good, right? That gasoline prices are low and that spending is high and that people feel comfortable borrowing. And you got to juice when you can juice. And even if you have to pay the piper long term, they're like, well, I don't care about the long term. I won't be here, right? Except some of the career politicians, but then they'll just explain it away.
Indicators of borrowing activity within the federal funds market suggest that stress within the U.S. banking system hasn't completely dissipated. While a decrease in overall volume indicates a reduction in excess cash, the gap between interest rates for borrowers in the top percentile of daily Fed funds distribution and those below is at its widest since September 2019. This widening spread implies that smaller institutions might still be grappling with higher borrowing costs, as noted by Bank of America strategists Mark Cabana and Katie Craig. Chairman Jerome Powell, in a news conference, acknowledged that inflation has somewhat moderated since the previous year's midpoint, yet achieving the Federal Reserve's 2% target remains a distant goal. Despite this, Powell left room for potential rate stability at the upcoming September meeting. He stated that the decision to raise funds in September could be possible if data supported it, while also suggesting the option of maintaining the current rates, emphasizing the careful evaluation process during each meeting. Powell emphasized that the Federal Open Market Committee will be closely evaluating incoming data and its implications for economic activity and inflation. In response to these recent financial developments, Mark Yusko provided his insights into the evolving financial landscape. He highlighted the significance of interest rates and liquidity dynamics, along with observations on the broader tech market's current trends.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I will make one caveat. That the FOMC, right, which is not just one guy or gal, but it's, hundreds of very highly educated PhDs,
Right.
on paper, very, very smart, right? And they've been predicting those two things, GDP and inflation, for dozens and dozens of years, right? Here's the crazy stat. This is a crazy stat. They are over on those predictions. Like literally 0 for 286 or whatever it is on the quarterly. It's you could flip a coin and be right half the time. They're horrible at that. So his commitment to say, I don't see, not commitment, but him saying, I don't see any more rate hikes, I'll take that as signal. Him saying no recession and inflation not coming down, noise, right? This is a guy who said inflation is transitory when it was 2% last time, on its way to 7. And now that it's fallen from 7 to 3 and probably heading for sub 2, probably even, I don't know that we'll get all the way back to deflation, but there are some things that are looking pretty ugly. So I don't take his proclamations there with that much seriousness. I really am struggling here because the stuff I see with my eyes, the anecdotal evidence, full restaurants on vacation, full airports, Taylor Swift grossing $1 billion on this tour. The estimates are that she's going to gross $1 billion and set the all-time record. When you look at that anecdotal stuff, it's like, wow. But when you look at other stuff like, credit card debt, multiple expansion, right? Stocks have not gone up because things got better. They didn't go up because earnings went up. They didn't go up because they went up because the multiple went up like a lot. Amazon is selling at over 300 times earnings. NVIDIA is over 200 times earnings. I mean, well, the 300 is actually unprecedented. The 200, we had that with Cisco in 2000, but 300, I didn't know what to say.
The Fed funds rate establishes the interest rate at which banks lend to each other overnight, but its impact extends across various forms of consumer debt, including mortgages, credit cards, and personal loans. The Federal Reserve's assertive approach to rate hikes harkens back to the early 1980s, a period marked by intense efforts to combat extraordinarily high inflation and a struggling economy. Recent developments on the inflation front have provided reasons for optimism, with the Consumer Price Index indicating a 3% increase on a 12-month basis in June, a notable shift from the 9.1% rate observed a year ago. Consumer sentiment is also turning more positive regarding future price trends, as highlighted by the latest University of Michigan Sentiment Survey, which foresees a 3.4% rate in the coming year. While these metrics, though notably lower than the current cycle's peak, remain above the Federal Reserve's 2% target.
Higher Fed funds actually makes banks more profitable. So, and if banks are more profitable, they can buy more stocks on their balance sheet, even though they're not supposed to, but they do. So that helps with the Ponzi of higher stock prices through multiple expansion. But the point is really, really well taken in that not only is the government fiscal spending really high, and particularly high in the defense sector, shall we say, that it just turns out a lot of our congressmen and senators own stock in these companies that are, they're voting to give money to Ukraine, who then gives it back to U.S. defense companies. In fact, I think it was Mitch McConnell said, you shouldn't worry about us giving money to Ukraine because it's coming right back. That's money laundering. That's not good, Mitch. Don't admit that out loud. But he did. And so that's real, right? That is real government stimulus, because those are American companies with American jobs, and people then go out and buy Taylor Swift tickets for $253 on average. Some usually more than that. But the other piece of it that's gotten lost is M2 ticked up. It ain't going down anymore. No more reducing the balance sheet. The whole, hey, we're going to reduce the balance sheet, quantitative tightening. You haven't heard the word quantitative tightening in months. No one's talking about it because M2 went like this. The bailout of SVB and the bailout of other banks. And look, banks are still failing, but the bottom line is monetary policy is actually expansionary, not contractionary, despite the rhetoric. And so I think those two things, and I think the monetary is important, but I think the fiscal is what's really being lost. 2 trillion is a lot of money. Again, anecdotal evidence says, yes, there is a chasing that occurs. Now normally it's late, like Q4, and that's part of the explanation of Santa Claus rallies, and also around the issue that mutual funds have to sell by October 31st. It's not December 31st. And so there is this downward pressure in mid-October. And then you get this, 30 days later, to avoid the wash sale, you get this increase. And then you couple that with a chase year. And that's why you get these big blow off rallies sometimes in Q4. One of the things about summer, right, is people go away. Like literally, I mean, you went away, I went away, people go away. And therefore less happens, volumes drop, and you've seen that in the stock market. You get prone to squeezes. And so, the NVIDIA thing happened, and I've seen it a couple times with other companies that quote unquote made earnings, which we'll talk about in a second. I'm like, no, you didn't make earnings. You told me you're going to make $1. Then you told me you're going to make 50 cents. Then you told me you're going to make a dime, and you made 11 cents, and you call it a beat. That's not a beat. I mean, you told me you were going to make $1 not that long ago. So, but the street thinks it's a beat, and because there's no one in their seats, you get a big squeeze, and they happen. So what I think is actually likely is, I think there has been chasing going on. It's just in terms of short covering. People have had to give in, and the number of liquidated shorts this year is an all-time record. It's never been higher. So all that quote unquote cash on the sidelines, I think a lot of it is back in the market already. And And yet, I do agree with you that there's going to be some people that wake up here and they look and they say, geez, I'm 500 basis points behind. And in the institutional world, 500 basis points is a massive hole because no one said we were going to be up 19% in the S&P this year. Not anybody.
Fed Chair Jerome Powell's recent statement highlighted the uncertainty surrounding the Federal Reserve's next move, following a recent rate hike. Economists on Wall Street are divided, with some believing that interest rates have peaked, while others anticipate further rate increases. Bank of America's Michael Gapin envisions another 0.25% rate hike in September, reflecting ongoing concerns about policy effectiveness. In contrast, Capital Economics chief North America economist, Paul Ashworth, firmly believes that the recent rate hike concludes the Powell Fed's historic campaign. The past 18 months have witnessed intriguing developments, including aggressive rate hikes and officials adjusting their messaging in response to evolving inflation realities. Beyond monetary policy, unique economic impacts have emerged, as seen with Taylor Swift's Fearless tour, which contributed to increased hotel revenue in cities like Philadelphia and Chicago. Swift's concerts, coupled with other events, showcase the potential for cultural events to influence local economies positively. As debates continue among economists, share your views on the likelihood of additional rate hikes this year in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.